Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. Money makes the world go round is a commonly used expression which stresses the importance of money in all our lives. However, from a business perspective, it means even more because money is the fuel that drives a business forward. This is why this presentation on sources of finance is so important. So what are we going to learn in this presentation? Well, first of all, we're going to find out about sources of finance suitable for large organisations, and then we're going to explore the advantages and disadvantages of each source of finance. Okay, let's get started by asking, what is finance? Finance refers to all the money an organisation has either borrowed or raised itself to pay for things such as starting or growing their business, purchasing assets such as vehicles or equipment, or paying bills such as electricity or heating. In general, the sources of finance a business uses for this can be classified in two main ways. First, either as internal or external, and second, either as short-term or long-term. As you might expect, internal sources refer to monies that a business has raised itself from its own operations, whereas external sources are when a business borrows money from another organisation. On the other hand, short-term finance refers to borrowing that is repaid within a year, whereas long-term finance refers to borrowing that is paid back over a period longer than a year. Okay, so with those points made, let's turn to look at sources of finance an organisation could use by asking, what is a bank loan? A bank loan is when a business borrows a large lump sum of money from a bank to finance the purchase of an asset such as equipment, machinery, or a vehicle. This external loan is then repaid in monthly instalments plus an interest charge over a long period of time, such as 5 years. This means that if a business borrows £10,000 over 5 years, that it will end up repaying around £13,000, the extra £3,000 being the interest charge. One of the big advantages of a bank loan is that it gives a business access to a large sum of money to purchase an asset that it would not be able to afford otherwise. Better yet, because the loan is repaid in monthly instalments, it makes it easier for a business to budget for such payments. Couple this with the fact that the interest rate on bank loans are quite low, and you can see that the loan repayments will also be affordable. However, although the interest rate on a bank loan is low, it still needs to be paid. Whereas some other sources of finance, such as retained profits, don't charge interest and therefore are cheaper. Further still, when borrowing money from a bank, security will often have to be provided. For example, if a delivery van is being purchased, the bank may insist that it is offered as security, meaning if the business fails to repay the loan, the bank can take the delivery vehicle and sell it to get their money back. Let's now look at a very similar source of finance and find out what a commercial mortgage is. A commercial mortgage, like a bank loan, is an external source of finance, which allows a business to borrow a large lump sum of money from a bank, which it then repays monthly plus an interest charge over a long period of time. However, unlike a bank loan, a mortgage is specifically used for the purchase of premises or land, and the period over which the mortgage is repaid tends to be longer, such as 15 or 25 years. As before, a big advantage of a mortgage is that it gives a business access to a large lump sum of money to purchase property it would otherwise not be able to afford. Further still, as a mortgage is repaid in monthly instalments, it makes it easier for a business to budget for the payments, especially as the interest rate on mortgages tends to be low. Even so, interest is charged on a mortgage, which means it is more expensive than other sources which do not charge interest, such as a grant. Furthermore, as the property or land purchased will have to be offered as security for the mortgage, it means if the business fails to repay, the bank can take the security and sell it to get their money back. Okay, let's now turn to look at a source of finance that overcomes the problems identified with bank loans and commercial mortgages by asking, what is retained profits? Retained profits describes the money that an organisation has left over at the end of the year after it has paid its taxes and the owners have taken their share. These profits, which can be saved by a business over several years and are therefore an internal source of finance, can then be used to finance different aspects of the business. As you may have worked out, given retained profits are an organisation's own money, they do not need to be repaid, and even better, no interest is charged. This means that retained profits is an extremely cheap source of finance. However, as positive as this is, it has to be remembered that the level of retained profits a business has available may be small, meaning some purchases will be too expensive. Further still, the owners of a business, such as shareholders, may be unhappy if an organisation retains high levels of profit instead of paying them out to them in dividends. Okay, let's now look at another cheap source of finance by asking, what is a government grant? A grant is an external source of finance that is provided by central or local government that an organisation can apply for if it meets certain conditions. For example, funding may be provided for projects that invest in an area of research and development the government wishes to promote, or if a business creates jobs in an area of high unemployment. One of the big advantages of a grant is that the money received does not need to be repaid, meaning it is an incredibly cheap source of finance. Better yet, as grants are often used by governments to encourage large businesses to set up in an area of its country that suffers from high unemployment, it means the grant provided can be quite large. Having said that, it needs to be remembered that to obtain a grant, an organisation will have to meet specific terms and conditions, meaning they will have to agree to spend the money received in a certain way. Okay, let's now move on to look at the sale of an asset as a source of finance. This internal source of finance raises money for a business by selling assets that a business no longer needs. For example, this could be old vehicles, premises the business has closed down, or unprofitable parts of their organisation. As you can see, given the money raised comes from the organisation's own sources, it means no interest will be charged and it won't have to be repaid. This of course means that selling an asset is a very cheap source of finance. Better still, if the asset being sold is valuable, for example, an organisation's branch network in a foreign country, it may allow a business to raise a lot of money. However, the problem with selling an asset is that it is a one-off event. It can't be sold again to raise even more money. Further still, in many instances, the asset sold, for example machinery, will have to be replaced by a more expensive, newer version. Okay, let's now have a look at a source of finance used by a huge number of organisations, and that is an overdraft. An overdraft is when a bank agrees to let an organisation have a negative balance on its bank account when it does not have enough money to pay for something that it requires immediately, such as inventory. Generally, once an organisation receives some money from either selling the inventory or from another source, it will put it back into its bank account and the balance will become positive again. As you can see, this external source of finance is incredibly flexible, in so much that it can be used as and when required by an organisation, meaning problems caused by temporary shortages of cash are avoided. What's more, given overdrafts are easy to arrange and rarely involve providing security, they are a convenient and simple source of finance for an organisation to use. However, as is always the case when borrowing from a bank, interest is charged when the overdraft is used. Further still, because the borrowing is not secured on an asset, it tends to be the case that a bank will only provide a small overdraft and at an interest rate higher than if it were a bank loan. Okay, so what did we learn in this presentation? Well, first of all, we found out about different sources of finance suitable for large organisations. And then we went on to investigate the advantages and disadvantages of each source of finance. This presentation has clearly demonstrated that there are a wide range of finance sources that an organisation can use. Nevertheless, that does not mean it is as simple as just choosing a source and everything will be fine. In fact, the decision on which source or mix of sources a business should use to finance its activities is a complicated one. This is because each source has its own specific advantages and disadvantages, which must be weighed up before deciding whether it would be appropriate or not for an organisation to use that source.